Thanks very much. Thanks for that very warm welcome. It's certainly great to be here. It's, I know, as you know, it's a long way to come, but I always seem to get a charge out of the energy in Australia. I always love coming here. In fact, I've been coming here fairly regularly as part of my duties, first in the financial sector and in the public sector, since the 1990s. In fact, at about the same time that Australia began its uninterrupted spate of record-breaking growth. Of course, that's just a coincidence. However, I must say, my duties previously took me to Sydney, to Melbourne, to Canberra, to Brisbane, to Adelaide, to the Gold Coast, and even to an APEC finance ministers meeting in Coolum. But I'd never been to the West Coast, so I was very happy for the invitation to give this keynote address at the 25th anniversary of the Diggers and Dealers Conference. And I want to thank John Langford and Nick Giorgetta for their very warm welcome. They made sure yesterday that I got to see the sights here, including the Big Pit and the Palace Hotel's mirror, the Herbert Hoover mirror. Now, you may not know too much about that, but Herbert Hoover, President of the United States, spent some time here. Does everybody here know about this? Yes, okay. But what you probably don't know that he was also president of Stanford University, which I'm a graduate. And I'm not aware they're aware of his love poem to the barmaid at the Palace Hotel, but I've got a copy and I'm gonna make sure that they get one. At any rate, I can see the organizers, John, Nick, and their colleagues wanted to start this day off with some high energy, and that's why they chose an economist to talk, I'm sure. So I asked John, well, what do you want me to talk about? And he said, actually, I don't care as long as you keep it short. And I said, well, John, what kind of an economist do you think I am? And he said, well, how many kinds of economists are there? And I said, well, near as I can tell, there are three kinds of economists: those who can count and those who can't. All right. Okay. Seriously. This is a very unusual time. One of, you've already, as Nick mentioned, as you all know, one of great uncertainty. So in my formal presentation here, I'm going to take a broad overview of what I think's going on. I'll make some specific references to the things that I think you should be aware about, and also try to deal with the things that I know you want to talk about. But I'm going to try to leave plenty of time for question and answers, and you should feel free to ask any detailed questions that I don't cover in my formal presentation. I'm also going to use PowerPoint. I don't often like to do that, but I want to get a bunch of information here, and I want it to be clear. So away we go. Well, this is a particularly good time for this exercise, as you know very well. Last month, the United Kingdom voted, or 2 months ago now, in June, the United Kingdom voted to withdraw from the European Union, sending shockwaves through global markets. They've since recovered, but don't underestimate the seriousness of this move and the effects it's going to have over the next few years, certainly on the economy of the UK. Something that you may not have paid much attention to is on just a week and a half ago in Chengdu, China, the G20 finance ministers and central bank governors met. And in just a few weeks, another month, in Hangzhou, China, the G20 leaders, the heads of government, along with their finance ministers, are going to meet. Now, I'm going to emphasize a bit the G20 because, among other things, I think it has been underestimated in the potential that it has to make an impact on economic policy and what it's trying to do, but where it's fallen short. Remember, the G20 represents about the leaders, or the countries represented in the G20, represent about, or account for about 85% of global GDP, about 75% of global trade, and about 65% of global population. That those leaders get together focused on economic and financial policy is actually unprecedented in world history. And yet, it doesn't seem to get the attention that I think it deserves. Well, remember, this G20 Leaders Summit process represents the principal institutional response to the global financial crisis. It was the effort to create a broader grouping of countries willing to get together in an attempt to cooperate and make their economic and financial policies more coherent. Parenthetically, one of the effects it did have was to bring Australia to the top table of negotiations and discussions on economic and financial policy. Now let's think back to what the G20 has been attempting to do. From their first meeting in November 2008 in Washington, and remember that's just a few weeks after the collapse of Lehman Brothers and the earthquake that affected first financial markets and then the global economy. The G20 set itself 4 basic tasks: restore global growth, repair and reform the international financial system, an agreement to prevent new trade protectionism and to promote new liberalization, and fourth, to reform and strengthen international financial institutions. And it wasn't just talk. They actually set forth and either created or created new institutions or assigned organizations the responsibility to accomplish this. Together, to deal with growth, they created what they call the Framework for Strong, Sustainable, and Balanced Growth, and created a framework working group at the deputy governor, deputy minister level to work on plans, specific plans, for making macroeconomic policy, budgetary and fiscal policy more coherent. To reform the financial system, they created the Financial Stability Board, and among other things, again, bringing Australia to the top table of discussions in these matters. For trade, they pledged the completion of the Doha development round of the WTO, parenthetically, subsequently abandoned. And for the principal element of reform of the international financial institutions was an agreement on funding and quota reform in the IMF, formally reached in the Seoul Summit in 2010. Now, here's the point. As I said, and as you now know, and as you probably already knew, the Hangzhou Leaders Summit is only a month away, and yet 8 years later, none of the agenda goals have been attained. Now, coming out of Chengdu, that finance ministers meeting of a few weeks ago that probably nobody here paid any attention to, they produced a communique, or the attendees produced a communique that I'm going to guess no one has read. It's 8 pages long, covers 16 specific topics, notes that there were 30 reports received from international organizations in preparation for the Hangzhou Summit, and listed 19 issues for further action in which it assigned specific jobs to various institutions. And they talked about, in the order in which they appeared in the communique, inequality and inclusion, financial market volatility, et cetera. You can read the list here. So lots and lots of topics, but really the main issue that they addressed was global growth. And let's think back for a minute on what the G20 strategy has been for restoring global growth. Back in the London Summit in April 2009, the first stage of the strategy was first, massive, unprecedented, and simultaneous easing of monetary policy, a uniform fiscal impulse of at least 2% of GDP for all G20 members, unprecedented support for the financial system, including direct government support in many cases. A factor that you may not have paid much attention to, the provision of unlimited currency swaps among the key central banks that helped keep, among other things, major European financial systems afloat. When they couldn't borrow dollars, the Fed was willing to lend unlimited amount of dollars to the European Central Bank, thus saving, for example, the German financial system. And the G20 provided $1 trillion in new funding for the International Monetary Fund to help support its anti-crisis efforts. Okay, that was the first step, but then what was supposed to happen? As private demand was recovered, the plan was to withdraw monetary and fiscal stimulus, to implement structural reforms that would have the effect of boosting productivity and potential growth, to strengthen financial sector resilience to make sure it wouldn't happen again, and to enhance the official safety net, in other words, the facilities and funding of the International Monetary Fund, among other things. And once again, today, 8 years later, all of this remains still a work in progress. And the consensus of the finance ministers in their Chengdu meeting just a week and a half ago is, in fact, that global growth is both weak and fragile, that it is uneven, that it is subject to substantial downside risks. So let's take a look at for example, in preparation for the Chengdu meeting, the IMF revised its World Economic Outlook forecasts. Here you can see their forecast for advanced economies expansion. Two things come up, and you can see in this graph. The blue line represents the actual and forecasted trajectory for global GDP growth of the advanced economies. That dotted line represents average growth rate from 1980 to 2007. What jumps out is something I think you all know. First of all, that the crisis 2008-2009 created a pretty deep hole. The economies have bounced back but have never filled in the lost output of the crisis. And even now, growth seems to have stabilized in the advanced economies at a rate notably below the long-term average. Not a very satisfying outcome. But perhaps, in some sense, even more concerning has been the outlook for the emerging and developing economies that in the early part of the 2000s were growing strongly at the moment of greatest optimism about this, among other things, about the so-called BRICS. But now we can look at the same figures, and we can see that according to the IMF, emerging market growth has returned merely to its long-term average. And do a mental exercise, take China out of that mix, and you can see that actually growth is below its long-term average for the emerging economies. So much for the notion that these economies are going to provide substantial growth leadership in the next few years. So there's the challenge. Where does it come from? Well, there's been a lot of talk about secular stagnation, about weak demand. But in fact, in most countries, consumer demand, including in places like Europe, consumer demand has actually been quite robust and performed quite normally. The principal shortfall, and I suspect this is something that this audience knows about, is the shortfall in global investment. And I'm telling you that, and I think the latest news has emphasized this has been the principal cause of sluggish global growth. That investment shortfall is also the explanation for disappointing productivity growth in most cases. And from what Nick told you just a few minutes ago, you can see that actually the mining industry here seems to have been an exception to this performance, where although investment has been cut back, productivity has increased. In the general economies, the advanced economies, it's been the opposite. Investment has slowed down, productivity growth has slowed down as well. In fact, here we can see in this slide a graphic demonstration of what I'm talking about. On the right-hand side, you can see gross capital formation as a percentage of GDP. There are a bunch of lines there, but the important one, look at the blue line, and you can see advanced economies, that gross capital formation has been slowing down most recently as a percent of GDP. For the emerging and developing economies, it's been a bit more stable. China, of course, has been off on its own with an unprecedented level of capital formation reaching almost at its peak nearly 50% of the Chinese economy, although it slowed. But now look over to the left side and look at what's happened to productivity growth. Advanced economies, productivity growth has been slowing. Emerging economies, productivity has been slowing. And most notably in China, where gross capital formation still remains very high relative to almost every other country on earth, productivity gains have now slipped back to a pace, or appear to have slipped back to a pace, not significantly different than other emerging economies. This is a problem that needs to be overcome if global growth is going to be restored. But it's broader than that when you think about it. Disappointing productivity growth is a principal explanation for the weakening in potential growth. In other words, if you're not making investments, and if your investments are not increasing productivity, then potential growth is slowing as well. And if potential growth is slowing and productivity growth is slowing, it's not surprising that, especially in advanced economies, there has been a process of weak income gains. And hence, when I said consumer demand has actually performed normally, that means that relative to income gains, consumer spending has behaved normally. But in most advanced economies, income gains have been relatively slow because growth is slow, because productivity growth has slowed. So we're in a spiral that is not favorable and needs to be reversed. And in fact, when you think about it, the surprising part is for the advanced economies, there's been a lot of good news that should have boosted investment. Record low interest rates, quantitative easing that has helped lead to record low long-term bond yields. As I said, relatively positive consumer demand trends. Lower energy prices and lower commodity prices. The latter part probably not good news here, but for most advanced economies, that should have been a boost to investment. Of course, in the near term, in places like the States, that has, in the short run, squashed investment in the energy sector, but should have produced medium to long-term boost to investment and increased optimism about it. But it hasn't. Well, investors have been talking a lot, almost obsessing about central banks and what they're going to do and what they're going to say and how they're going to arch their eyebrows when they talk at press conferences. But nonetheless, the central banks, for instance, the Federal Reserve and the Bank of England prior to Brexit, had assured us they were going to be very cautious about any policy tightening. And the Bank of England, post-Brexit vote, have now told us that they're standing ready to ease policy. And of course, the expectation is that both the Bank of Japan and the ECB, the European Central Bank, are going to increase their quantitative easing efforts. But there's little conviction among investors that those actions will have any important effect. Why? Well, I don't want to dwell on this, but when you think about it for a minute, it's not so strange. As my friend Peter Fisher, professor at Dartmouth University and former official of the US Treasury, says, low long-term interest rates don't always and at all times encourage activity, economic activity, because if long-term rates are low and expected to stay low for an extended period of time, of course they're helpful for demand, but how about the supply of credit? So his claim is that expectations of sustained low long-term interest rates actually, in current conditions, don't represent an important stimulus, which looks consistent with what we see today. Nonetheless, when you talk to, in the real world, to both bankers and to corporations, what you find is the idea. What they'll tell you is lack of demand for credit is more important than lack of liquidity. So an important question is, why haven't producers and investors been more optimistic about new projects and new demands? Well, in addition to this question whether sustained monetary stimulus really has much positive effect anymore, here are some other potential effects and explanations. One is simply that the trauma of the global financial crisis is lingering in its effect and creating uncertainty and doubts about long-term capital expenditures. Important issue for this audience. And I'm sure all of you have seen, at least in many advanced markets, that companies announcing long-term CapEx programs, investment programs, typically are not rewarded in stock price. What investors these days want to see seems to be buybacks and getting cash back. And secondly, when you look at the eye-popping record low yields on government debt in advanced economies, in some cases, as you know, moving into negative territory, savers paying governments to hold on to their money for several years, you can wonder, is this an effect of population aging and a growing preference for safe income over capital gains that result from risk-taking? You can also imagine that in some cases that the incomplete financial sector repair and the lingering of bad debts and inaccurate asset valuations on some financial sector balance sheets is also an inhibitor. In any case, these all need to be overcome, and there's no magic bullet that is going to do it quickly. Hence, the level of concern that the G20 expressed about the dissatisfaction with current growth rates, but more importantly, with the prevalence of downside risks to the outlook. Let's look at a little bit more specificity in what they're showing. Here we can see rather uneven forecasts for advanced economy growth. The US, not as good as their long-term growth, but not so bad either, moving along steadily. The Euro area, actually having recovered in the last few years, not growing spectacularly, to put it mildly, but at least to showing positive growth. And this is an area, of course, where the IMF and the G20 perceive there are downside risks. But look at the outlook for Japan, essentially a return to virtually zero growth. Now, this is one way of looking at it. Here's another way. Look at this in cumulative terms. This means this measures real GDP growth compared to the final quarter of 2007, before the onset of the crisis. And you can see the rather great difference between the growth performance of the US economy versus that of the European Union countries and Japan. Now, this is one way of looking at it. This is just comparative GDP growth. We can see how much faster, in cumulative terms, how much further the US economy has grown since the crisis compared to the others. But now do this in per capita terms, and things look very different. Here, because of the decline in Japanese population, the outright decline means in per capita terms, their growth performance isn't that different from the US. But when you look at the European Union, you can see that even today, they have not recovered per capita output levels of before the crisis. In case you wonder where the degree of skepticism and pessimism comes from about the European outlook, it's from that fact as much as anything. But actually, when we look at the Eurozone, you can see that there has been some convergence. Sure, places like Portugal or Greece get a lot of headlines, but they're tiny in the context of the European economy. Actually, growth rates have stabilized, just not at a very positive place, not as positive as you would like. And there are obvious risks created by the strains still remaining in the European Union. But this outlook has some implications that is important for this audience. One, advanced economy inflation remains not only below target, but even though here you can see in the IMF forecast a modest upturn in inflation expected over the next 18 months, actually still would leave inflation below the central bank's target, which is now pretty uniform across the advanced economies, about 2%, and a continued slowing of inflation in emerging markets and developing economies. In other words, with this growth outlook, looks like we're going to continue with a world of very low inflation, hence the the record low long-term interest rates. That's had another implication that this audience knows well. Moderate global growth has produced moderate trade growth. There's been after a long period, basically decades, in which growth in world trade outstripped that of global GDP, it has now settled down to something that is more equal. And here's another trend that is perhaps surprising. What that has meant, here we see in this slide on the left side, advanced economies. The blue is growth in trade volumes versus red growth in real GDP. And we can see the slowdown in the last few years in the growth of trade relative to GDP. On the right-hand side, you can see the same figures for the emerging economies. And what is notable here is that actually trade growth is slower than growth in overall GDP. In other words, for now, trade has turned into a drag on the growth of emerging markets, not the other way around. Hence, the importance for the global economy of the advanced economies, increasing investment and speeding their growth. Well, this is the not so great implication of this consensus forecast, which is with growth essentially stable and slower than it has been in the past, the outlook for commodity prices, as expressed in futures and other markets, remains modest indeed. Energy has recovered somewhat, and of course, as Nick pointed out, in the last few weeks, really, there has been improvement in some commodity prices, probably as the fears about potential downturn or central bank action has actually relaxed investors about near-term threats. But still, with global growth continuing weak, it's hard to imagine a big upturn in the outlook for commodity prices. Another aspect that has changed, has resulted from this environment is that capital flows to emerging markets has, in the past couple of years, turned, on balance, negative, long-term capital flows. Here we measure it by flows into emerging market investment funds. That has improved in the latest data, but basically what had been in the past as a tailwind has in recent terms become a headwind, which also has been a factor in holding down investment in these countries. Around here, I'm sure there's a lot of interest in what's happening in currency markets. And on this graph, I chart what has happened to currency markets. Really, this shows since January 2013. And what I wanted to show is the effects of the post-Brexit moves in currencies. These are graphed in what are called real effective exchange rate terms. You probably know those terms. But basically, it means trade-weighted and inflation-adjusted. And what are the notable things you can see here? That green line is the UK, and you can see the very substantial weakening of the pound, not just in bilateral terms against the dollar, but in real effective terms. You can see the strengthening of the yen, but when we look in broad terms, it's really back to where it was a couple years ago after a period of weakness. It has obviously dismayed the Japanese authorities, who don't want this to happen, but they don't have any obvious tools to reverse it other than direct intervention. And if you read the G20 communique, it says that's a no-no. And you can see why the G20 may be a bit skeptical about the Japanese claims, because if we look on a medium term, just the last few years, they're just back to where they were. The dollar continues to climb, and by now its cumulative strength is probably enough to start having some impact on the US economy, and probably therefore some indirect impact on Fed policy. And here we can see the Chinese currency moves, but important here is that if we look over the last few years, the Chinese currency has actually strengthened along with the dollar in real effective terms. So this is hard to think that these currency moves have been destabilizing. They seem more normal and natural, but represents a challenge to some degree, I don't want to overemphasize it, to the US economy. There's been some other aspects I just want to mention. The increase in fiscal debt in the advanced economies. And here on this graph, we can see on the right line, the red line, sorry, the growth in gross debt as a percentage of GDP and how strong that has been. But structural primary deficits have fallen in the last few years. The main point is the following, that if we look at current budgetary plans, there is, on the one hand, no one is planning any substantial fiscal tightening. So worries about austerity are misplaced. On the other hand, there's no sign of fiscal stimulus coming down the road. Well, let's talk about Asia for just a minute, and let's talk about China. The IMF says China's economy is at a critical juncture. They say that China has done more to liberalize economic activity than they have to impose discipline on borrowers. So in fact, in the latest figures, growth in services in China have been more important, have accounted for more than half of GDP growth. Industry now down to about 41%. But it's been accompanied by rising credit, structural excess capacity, especially in steel and coal, and the development of an opaque and interconnected financial system. As you probably know, debt in China is now up to about 225% of GDP, and the government accounts for only about 40% of that relative to GDP. Households, another 40%. The balance, 145%, accounted for by corporations. State-owned enterprises account for 55% of, in GDP terms, of all credit, but their output is only about 22% of GDP. In other words, the problem is obvious. So what are the tasks for the Chinese economy and their reform process? Slow credit growth, limit off-budget investment, fix local government finances, strengthen social safety net, control pollution, strengthen the banking system, which has non-performing loans of about 7% of GDP, enhance exchange rate flexibility, increased data availability, and improve communications. Pretty big task. What the Chinese authorities have shown so far is that they are sensitive to the slowdown and are still resorting to strong credit growth to produce GDP growth above 6%. The IMF says 6% or so is sustainable, but with these reforms. And without these reforms, it seems unlikely that they can sustain these without producing some serious imbalances. Challenges to come for the Chinese economy. India has been a bright performer, but they have their own challenges. Of course, their economy produces at a much lower level. Average GDP is about a quarter or less than a quarter of that, per capita GDP in that of China. The new government has a long list of important reforms coming in agriculture, labor laws, cleaning up state bank balance sheets, measures for financial inclusion, creation of a bankruptcy code, the so-called Make in India program to increase the role of industry and manufacturing. But so far, those remain plans. They need to be implemented for these even this kind of 6% plus growth to be sustained. I won't spend much time here on Latin America, but I'm happy to answer questions if you'd like. And here, the recent performance has been striking and extremely disappointing. Look at this. Latin America has basically shown in the last year zero growth, with the largest economy, Brazil, in a deep downturn. The good news is it looks like that may be coming to an end. The bad news is this is still very, very low growth for a relatively poor continent that should have room for much more rapid growth. I'd be happy to take more questions on that. As I say, the good news is it looks like the worst is over, and there's certainly a big change, potential big change, in policies coming from the change in governments in the biggest economies. Nonetheless, this remains a work in progress. Two things I want to show you. First, here is don't worry too much about the details. I'm showing you some figures of something called S-risk, which is an estimate of the aggregate shortfall of capital in the financial system in the event of a crisis. How vulnerable are economies to new financial systems to new economic downturn. And what this shows is the great difference in fragility of the financial system between the US and Europe. Here's the real reason I want to show you this. Now, don't worry about looking at the details. This shows this by country. What it says is, by this measure, which is admittedly a somewhat experimental measure developed by the folks at the New York University Stern School, says by market measures, the riskiest financial system is that of Japan, followed by that of the UK, followed by France, Switzerland, Spain, ... There at the bottom, I wanted you to see, is Australia. So here's a measure that says that Australians' financial system resilience is tops. So let's hope that this is accurate. And why not? And let's hope that what I've described to you, I think, is a global outlook that is based on the notion of only moderate performance, still pockets of problems, but real downside risks that I've tried to lay out at least in broad terms. My hope, and the optimistic case, is that in fact, as we move through and produce a moderate growth performance, and the downside, if and when the downside risks fall away, that this will produce positive reinforcement that will tend to produce increased confidence and increased investment. So my hope is that the flaw in this consensus outlook is that if it comes true, it will be confidence building and will start to produce positive responses. The happy news for the gold miners is in the near term, the uncertainty is generally not a bad thing for the gold price. There are just a couple things I want to point out. On that, going back to that original set of strategies, here are some things that still remain quite much in process. Trade negotiations. TPP is of interest to this country. We've had now in the US, as you know, both parties say that they find the current TPP agreement unacceptable. Where does that lead us? The focus in Europe on Brexit negotiations means that the UK is going to have to renegotiate trade deals with everybody. Hard to imagine how this is going to work. But it probably makes TTIP, the transatlantic trade agreement, a moot issue for now. So here, instead of progress, we've been moving in the opposite direction, a source of concern. And on global governance, I don't want to go too far, happy to answer details, but instead of increased coherence, we've added to complications. The new AIIB, the new development bank, the Silk Road Fund, the huge initiative represented by the One Belt, One Road program of China is one that creates possibilities, real opportunities, potentially a real positive for the world economy, but in the short run, injects new uncertainty into the process of global governance. So, lots and lots of things to think about and deal with. On to Hangzhou, where the G20 leaders in just a few weeks are going to get together. And what they're going to try to do is create the impression for you that there is, in fact, cooperation and coherence in economic and financial policies that are going to underpin your confidence in a more positive outlook. Could it happen? What I'm telling you is it's possible. It's possible. But the challenges are very real. Thank you very much.